I'm Jerry Boyer, and you're watching the Eagle Investing Network. I want to continue our discussion about the United States versus the rest of the world as an investment story and a macroeconomic story. And really, those are the same things. Investment over the long run, that is returns, over the long run, tend to be driven by economic performance. I know people say that markets and the economy don't have anything to do with one another. Well, they're wrong. They have a lot to do with one another. Yeah, you can't track day by day. A better economy is better market performance. There's other things in the mix, for example, valuation, etc. But over the long run, countries with growing economies tend to be countries whose broad stock market indices overperform. There's something in the economics literature called home bias. What's home bias? Home bias is that people tend to only think about investing in the country in which they live. This is a very strong factor, including with Americans. We think that if we're making the decision about whether to buy American stocks or American bonds, we're diversified. Well, no. There's something like 60 other investable countries in the world that also have stocks and bonds. So the broader the universe you can choose from, the more chance you have of picking winners. Of course, it's also more chance of picking losers, so you have to do it in a smart way. Now, for a long time, the United States was a very large proportion of the global economy. Let's look at the data. This particular data set only goes back to 1960. And let me just tell you what we're looking at across the bottom from left to right is time. 1960 to 2020. Why not more recent? Because I'm trying to get you to see a historical trend. And we don't have global information because some of these little countries are a little slow to report their information. So we can't get the world GDP numbers as quickly as we can get US GDP numbers. So the red is US GDP, and the bluish, greenish here is world GDP, world economic output. Now, my friend Dr. Mark Skousen would tell you gross output is better than gross domestic product, and he's right. But we do not have available world gross output data yet. The economists in these various central banks and bureaucracies haven't caught up with the best in economic thinking, so we're stuck with GDP. And it still is worth telling us something. And what we're gonna see here is the difference between the red and the green will be essentially kind of what proportion we are of the global output. So the green is the world without us, the red is the world with us. So let's play it. Play the data. And we can see that they're pretty close together. After World War II, we were basically half of global output. But something happens in the 70s. To become rich is glorious, said one of the Chinese dictators. And so there was a shift somewhat towards a market economy. And then we have the tiger economies in the 1990s. That bubble pops, though. And we have more China growth in the 2000s. They become a serious competitor. And really, the world is growing faster during most of this time period than the United States is. So it's growing up faster. Everything's going up. Generally, we're getting more prosperous. Yes, we do have the Great Recession and we have COVID. We have setbacks in the human story. But in general, both lines are going up. But as you can see, the world is growing faster. The world ex the United States, ex-US, is growing faster than the United States. So our share of global output is this compared to this. This is how big we are compared to the rest of the world without us. And what you see is, as this gap is growing, we are shrinking as the global output share. In other words, if you think of the global economy, if you're 100% in the United States in terms of your investing, understand that you have limited yourself to basically 24% of the global economy. The United States is 1/4 of the global economy. And if your portfolio is 100% United States, then you're not diversified and you're missing opportunities. Now, there's a certain risk overseas as well, but I think we're seeing that there's a certain risk in the United States that maybe we've tended to ignore. So if you are taking the economic output as the baseline, we see that it's a big world and it's getting to be a bigger world. And as the United States is slowing down in competitiveness and slowing down in growth compared to the rest of the world, we are a decreasing share of the world economy. So one of the ways to invest in the most of the world economy, in order to invest in the majority, the 76% of the world economy, some of that is done through U.S. multinationals, but directly involves international investing. You're not diversified if you're just the United States. So we're going to take a look at some more factors that should give us some concern about a U.S.-only approach. By the way, I'm not saying don't invest in the United States. Only fools would bet against the United States. But I am saying diversification is important, and that includes international, and that the U.S. faces some challenges right now that we all need to be aware of if we're not already. I'm Jerry Boyer. This is the Eagle Investing Network. Make sure to hit subscribe. Make sure to share this with somebody else, and thank you for watching.